Ladies and gentlemen, good day and welcome to PI Industries Limited Q4 FY2025 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nishit Solanki from CDR India. Thank you, and over to you, Mr. Solanki.
Thank you. Good afternoon, everyone, and thank you for joining us on PI Industries Q4 FY2025 earnings conference call. Today, we are joined by senior members of the management team, including Mr. Mayank Singhal, Executive Vice Chairman and Managing Director, Mr. Rajnish Sarna, Joint Managing Director, Mr. Sanjay Agarwal, Group Chief Financial Officer, Dr. Atul Gupta, CEO Exports, Mr. Prashant Hegde, CEO Domestic Brands, and Dr. Ramesh Ramasubramaniam, Global CEO PI Health Sciences. We will begin the call with key perspectives from Mr. Singhal. Following that, Mr. Agarwal will share his views on the financial performance. Thereafter, the forum will be open for question and answer session. Before we begin, I would like to underline that certain statements that may be made on today's conference call may be forward-looking in nature, and a disclaimer to this effect has been included in the investor presentation shared with you earlier and also available on stock exchange websites. I would now like to request Mr. Singhal to share his perspectives. Thank you, and over to you, sir.
Yes, thanks, and good afternoon. Thank you, everyone, and good afternoon to all present. I aim to discuss the operating environment and provide you an update on our strategic initiatives to enhance our global position as a leader in technology research and manufacturing in the life science arena. Let me start by providing a brief perspective in the industry scenario. While the overall crop protection market continues to expand, challenging emerges in the form of extreme climate events, commodity pricing, tighter regulations, softer farm sentiments. Pricing pressures which weigh on the pace of growth. The industry is steadily pivoting towards more sustainable practices with growing investments in innovations of biologicals, precision agriculture, and digital farming. In the recent months, trade flows have been impacted by tariff wars. However, in the mid to long term remains positive, driven by the rising needs of high agricultural productivity, greater resilience against climate threats, and faster shift towards sustainability. Domestically, the signs and the volume growth has observed driven early kharif sowing activities and favorable monsoon indications. The adoption of biologicals gained further momentum, aligning with the broader sustainable trends. Nevertheless, price realization remain under pressure due to global oversupplies, increased generic competition, and declining raw materials costs. The sector growth trajectory will increasingly be influenced by innovation in differentiated solutions and shift towards sustainable crop protection and supportive policy measures. Amid the business environment, outsourcing still remains a strategic imperative for multinational companies. In the agrochemical, cost competitiveness, supply chain diversification, and need for stronger regulatory compliance are driving innovators to outsource manufacturing to India. While in the pharmaceutical industry, outsourcing aligns with high-value complex segments driven by end-to-end need for regulatory and scalability. Both sectors are shifting towards deeper long-term partnerships with companies prioritizing resilience, operating efficiencies with a focus of technology and innovation. We are targeting growth opportunities in the CSM and expanding the addressable market of 15 to 20 billion in innovative products in ag. In parallel, we are actively positioning ourselves to capture across the value chain of the multi-billion-dollar market of pharmaceuticals in the CRDMO and electronic and biologicals. This is well in line with a transformation from ag science company to a life science company. Once again, the PI team yet again has delivered a commendable performance in Q4 and for the year as a whole, given the environment. Our standalone performance for the year featured 6% growth and a revenue 17% growth in EBIT. Broadly in line with our guidelines, the consolidated financials were marginally lower due to development spends in the newer business arenas. During 25, our AgChem exports have continued to show improvement with 5% growth. which is in line with the plans. The growth are mainly driven by our new products commercialization of the last years, with a 31% growth which we've been able to achieve year on year in this area. Over the past years alone, we have commercialized 15 molecules. Our pipeline remains robust, with approximately 50% inquiries are also now being focused on non-active molecules. Moving towards the domestic operation in Q4. Our strong domestic brands have shown a growth with 21% year-on-year growth. Our steadfast focus on product mix of innovative crop solutions to approach yields and the desired results to the farmer. Our biological range again continues to show strength on strength with a strong 20% growth from over the prior years, which has already been on a very high growth rate over the last 3 years. Domestically, we have introduced 7 new brands in this year. Further, we have a pipeline of 20-odd products at various stages of development to be introduced over the years. So while our core business mix assures a sustained traction for the coming year, the development of new verticals contribute to the future performance as we are transforming from a pure AgChem leader to a life science powerhouse and aiming to become a global technology platform leader in biological space while becoming a differentiated player in the CRDMO pharma play. While we continue to build a full integrated CRDMO platform, providing world-class solutions backed with strong knowledge and high-quality assets across from research, commercial to manufacturing, with excellent leadership now in place, we are on an accelerated path to look for growth. During this year, we have upgraded and added our asset bases across geographies in alignment to our strategy to meet our customer needs. Moving on to our biologicals, this category is offering and has experienced at the fastest growth rate in the recent times, outbeating the industry. Acquisition of Plant Healthcare, which has a specialization in peptides, marks a significant step towards our intent of becoming a platform technology-based product solutions and biologicals to serve the global markets. This is very much in line with our purpose of building a healthier planet. We are also making good progress on our proprietary offerings. We, as PI, with our first new entry from India to the world, which is currently in the midst of phase 3 trials, we are evaluating with partnerships across the world and developing regulatory data. Additionally, our R&D programs are giving us some positive progression leads to build a pipeline with exciting outcomes. The initiatives are perfectly aligned with our strengthening our position as a technology leader and a manufacturing powerhouse to bring opportunities for partnership models across the globe. We have remained the leader with the chemical industry in ESG. Having achieved acclaims, we are proud to have retained our listing in the prestigious S&P Global Sustainability Yearbook for the second time in 2025, which speaks volume of our ESG journey. While the global industry navigates trajectory headwinds and general business dynamics remain uncertain, we maintain our growth outlook, expecting the broader sentiments to improve in the second half of the year. We are confident in the long-term prospects of growth outlooks. Our investments in new capabilities, capacities across the business lines at a global level remain on track, setting the stage to deliver a vision. With this, thank you to all of you for joining the call. I would now like to hand over to Sanjay, our CFO, to take this, and over to you, Sanjay. Thank you.
Thank you, Mr. Singhal. Good afternoon, everyone. On the call today, I will summarize the company's financial highlights for the quarter ended 31st March 2025. Please note all the numbers which we are talking here are on year-on-year basis. Comparisons are on year-on-year basis and refer to the consolidated performance. So to share the performance highlights during quarter 4 FY25, we reported a revenue of 17,871 million, a growth of 3% over the same period last year, which implies a 3-year CAGR of 9%. While there's a decline in the AgChem exports, the volume is up by 7%, and new product growth is 23% year-on-year due to scale-up of products commercialized over the last 3 years. On our domestic branded revenue business grew by 21% year-on-year, supported by a strong Rabi season, marked by increased acreages in wheat, rice, and pulses. Pharma business also had a strong sequential revenue growth of 33% to rupees 850 million in quarter 4 or FY25. In spite of all the development expenses we had in pharma and our PHC business, a consolidated EBITDA grew by 3% and remained at a healthy 25.6% due to good product mix and tight overheads management. Let me also cover the performance for the full year FY25. Revenue was 79,778 million, a growth of 4% over the same period last year, which implies a 3-year CAGR of 15%. New launches and biologicals remain a key feature for us in FY25. AgChem export revenue grew by 5%. Our new product growth is 31% year on year, and domestic branded revenue business grew by 6% and a volume of 9% up. So our momentum for launches of new innovative products has continued with 7 new products launched during this year with a crop solution approach, and similarly a biologicals business on a yearly basis grew by 20%. On consolidated basis, the EBITDA grew by 8% for the full year to 27.4%. On a standalone basis, if we look at it, our EBITDA grew much higher at 17% and PAT grew by 8%. On a consolidated basis, the profit is marginally down by 1% at rupees 16,602 million, impacted slightly due to a higher ETR at 22.5% versus 11.2% in the last year. We expect ETR to be in the range of 20-23% for the next 2 to 3 years. The trade working capital, the number of days, it has increased to 73 days, while the better inventory management has led to reduction in inventory days from 62 days to 45. Our balance sheet further strengthened during the year. Our net worth increased to rupees 1,01,570 million, and with a very healthy net cash balance of rupees 40,926 million. In summary, our healthy financial performance leading to stable cash flows provide us the flexibility to continue with our growth plans. And our CAPEX spends allocating additional capital towards our future growth engines in PIHS, our pharma business, and PHC, our global biologicals franchise. This gives us confidence to have a focused growth. With this, friends, I'll conclude my opening remarks. I'll now request the moderator to open the forum for Q&A. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. As a reminder to all the participants, please restrict yourself to 2 questions. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. The first question comes from the line of Rohit Nagaraj with B&K Securities. Please go ahead.
Yeah, thanks for the opportunity, and glad to hear that the MC has moved to phase 3. Just one question on the MC Pioxaniliprole. In terms of what is the time to commercialize that we are looking at, and how much have we already invested in terms of R&D, and how much incremental R&D investments are likely to undergo for this MC? Thank you.
Maybe I'll take that.
Yes, sir.
Yeah. Okay. So we are expecting, as we explained, we are right now in the process of, regulatory data development, evaluation, and also application preparation. We expect to commercialize in the very first country in the next couple of years. As regards the second part of your question about the investment, etc., this is not in front of us, and also it is very confidential data. So I hope this helps your this information helps you in your question.
Sure, sir. Thanks. So second question in terms of what is the composition of the new high growth molecules in AgChem CSM by the end of FY25, and similarly the composition of biologicals in our domestic branded business at the end of FY25. Thank you.
Yeah, maybe I can help you on that. Biologicals business would be around 18 to 20% of our total agri business, AgChem brands business in India. And similarly, the new products are broadly 15 to 18% of.
Ladies and gentlemen, the management line has been disconnected. Please be on hold while we quickly get them reconnected.
Hello.
Ladies and gentlemen, the management line has been reconnected. Please go ahead.
Nishid, should I repeat the answer to the earlier question, or did we move on to the next one?
So if you could repeat, I think the line got lost in between. Thank you.
Okay, so I'll just repeat. When we're talking about new product launches and their contribution to our AgChem export business is around 15 to 18%. And similarly, the biologicals business for our AgChem brands business accounts for around 18 to 20%. The biologicals business is the last question what you asked.
Right, sir. Thanks a lot and all the best.
Thank you. The next question comes from the line of Vivek Rajamani with Morgan Stanley. Please go ahead.
Hi, sir. Thank you so much for the presentation. Just continuing with the question on the new products in your portfolio. For fiscal 25, they've grown at about 30% plus. How should we be thinking about the growth of these new molecules in fiscal 26 or even fiscal 27? And as a related question, these new molecules grew about 40% plus in 2Q and 3Q, and about 20% plus in the remaining 2 quarters. So any thoughts with respect to is there a seasonality element here would also be super helpful. Thank you.
Yeah, so I think for the next financial year also we can have a similar new products. As you know, the new molecules are getting commercialized. 15 got commercialized in the last 3 years, so they'll continue with the same momentum of new products adding to the top line growth and giving us stable margins on that.
Sure, sir, that's helpful. And anything with respect to seasonality? Or it would just be equally spaced across the...
Well, let me be very straight. Seasonality, as you have seen over the years, quarter to quarter variation always happen. It depends on demand, supply, market situation, positioning. So yes, that will continue to happen. That's the generic DNA of this business.
Sure, sir. And just a clarification, if you're going to continue the same momentum on these new molecules, would it be fair to say that the 15 to 18% of contribution that we have as of this year, that number could probably be maybe north of 20-25% by the end of next year? Would that be a fair assumption?
Well, I would not put it as a clear-cut mathematical computation, but yes, because there's a variation volume, price, multiple things come together. But objective is to continue to increase this portfolio because some come in and some go out, right? That's the strategic way it works, but that's the bandwidth which you work in.
Sure, sir. Thank you. I'll rejoin the queue and all the very best.
Thank you. Next question comes from the line of Abhijit Akela with Kotak Securities. Please go ahead.
Yes, thank you so much and good afternoon. So the gross margins this quarter seem to be really strong, almost at record levels, despite the fact that there been some price cuts in the CSM business, as we alluded to in the presentation. So just sort of wondering, what's behind the really strong gross margins. And with regard to the EBITDA margin outlook for fiscal 26, what's the range we should work with? Is it, this quarter we've reported 26%, but the full year was 27%. So what's the right number to work with for next year?
So if you were to look at it, again, strategically, as I said, quarter to quarter would not be the right way to look at numbers, but yes, the margins are based on clearly product mix, good aggressive growth in the domestic business, followed with how we look forward, as you indicated earlier, we continue to keep those guidelines between 25% or plus of our EBITDA margins continue to go up. Yeah.
Speaker, this is the operator. Can you come a little closer to the mic while you answer? Thank you.
Yeah, so as you've indicated clearly, product mix with the strong growth seen in the domestic business and continuing to look at the margin going forward, as indicated, we continue to maintain our guidelines on the same.
Okay, thank you. And the other thing was just on a couple of data points, if I may, for Mr. Agarwal. One was, what was the pharma EBITDA loss for fiscal 25? We've given the PBT loss, but would it be possible to just share the number at the EBITDA level? And the presentation states that there's this aspirational target of increasing the biologics revenues 5 times in 5 years. So where do those revenues stand at present, and therefore where do they go in the next 5 years? Thank you so much.
Yes, the EBITDA loss for the full year has been in the range around 180-190 crores. Hello?
Yeah. Okay. Thank you for that. Yeah. And the biologics revenue, what is it exactly right now in absolute rupees?
Sorry?
The biologics revenues, what is the amount right now at present?
No, we spoke about it, that the biological business contributes around 18 to 20% of our India agri brands business.
Yeah, but the presentation says we want to increase it 5 times in the next 5 years.
Yeah, so I think it is clearly we are looking at, you asked 2 questions, I think, the biologicals. One is what is that we are looking at, it's already stated it's 5x, clearly. Today we are at something around in
35 to 40 million. We are at 35.
No, you're looking at, I was just converting that, 280 crores right now, which will probably move up to 5x. So we look at 1,000 crore targets in the next 5 years, to be clear. 1,000, 1,200 crores.
Understood. Thank you so much. That's helpful. Thank you, and all the best.
Thank you. Next question comes from the line of Ankur Periwal with Axis Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. First question, on the margin outlook for us. Now, as I understand, pharma losses are expected to go down, as we look to ramp up this business over the coming, FY27, FY26 or, 2 to 3 years. At the same time, the AgChem business is going to see more launch of new products, which presumably will be a better margin. And still we are maintaining our, overall guidance at the same level as FY25. Is it that there is some bit of pricing pass-through or maybe some pressure that we are seeing in the older products, or, if you can help your thoughts over there?
Well, I think, I think you should look at the businesses not by path through ABC. These don't run like a clear cookie cut, but to be very honest, there are investments and overheads which are being built up. So ratios are different, but on an overall blended basis, we've indicated where we are looking in terms of margins, and that's what the company will continue to maintain and grow with.
Okay, fair enough. Second bit
and at
on,
the same time, I think just to appreciate that the company is investing hugely to build a global footprint in biologicals and in pharma and cost of running global organizations from a different cost structure. So taking all those blends and building up to create the nice next play to be in the life science place needs investments both in human capital and other areas.
Sure, sir. Secondly, on the pharma business, while we are, targeting a much sharper sort of, revenue growth going ahead, will we need an incremental FDA-approved or maybe a bigger production facility for this business to ramp up, or that is still some time away and probably, nominal CapEx will do here?
So, well, clearly, I think there's a step-by-step approach. We have present assets which have been upgraded with investments. Clearly, as we see things turn around the corner, and you very well would understand this it's an asset-led business. And as we see things turn the shape to our grades, we'll definitely be looking to scale up as we have ambitions to put a huge number in scale to grow to this business.
Sure, sir. Just one last bit, a bookkeeping one. So in the balance sheet, we have a contract assets of around 430 odd crores, which was around 150, 160 crores last year. If you can just highlight what exactly is that for?
Yeah, so these are standard industry practice of having any contracts where the goods have not been delivered before the cutoff date. So these are specific contracts wherein the goods are produced for a particular customer and which have now been subsequently been billed or shipped out in the next subsequent months.
Sure. Agarwalji, is this for pharma or for the AgChem export bit?
It will be in both of the businesses.
Okay, great. That's it from my side. Thank you and all the best.
Thank you, sir.
Thank you. Next question comes from the line of S. Ramesh with Nirmal Bang Equities. Please go ahead.
Thank you and good evening. In the pharma business, when you're looking at improvement in margins, is it possible to share what is the kind of improvement in gross margin you can expect from this 52% in FY25? And in terms of the run rate for the overheads at this 306 crores in FY25, do you see this stabilizing at these levels with marginal inflation-related increase, or would you see further increase in overheads?
Well, I think the overheads have been, this particular financial year, we had unfortunately some one-offs which we had to take care of it. Going forward, what I can say at this point of time, the business is built with the gross margins of around 60-65%. And with the scale up of the revenue, the operating leverage will start kicking in and we should have a better profitability at the bottom line as well.
So can you share what is the one-off impact of the old inventory write-off, which is increased overheads?
So, as you know, any business, currently the overheads what we have been much higher versus the revenue what we have. But difficult for me to give you the exact numbers, but the current overheads have these development spends. They've been, as we spoke in the Q2, we had one particular customer where we had to take a doubtful debt provision and some other one-off costs which impacted this year's, which led to a higher overheads in this financial year, which we do not think would be there in the times to come.
Okay, so on the domestic business, with the current run rate of around 1,400 crores, what is the kind of potential you see, or when do you think you can say go to over 2,000 crores? Because a lot of small peers are already at 1,700 to 1,000 crores, and you have so many new products being launched. So what is the kind of direction you are seeing this business heading towards over the next 2-3 years?
Well, I think domestic business is about 1,500 crores, but it's pure brand business. Whereas when you're comparing to other smaller players, they also have technical and B2B business and exports. So PI is just a pure business brand play, That's for one clarification. Clearly, as you indicated, we're looking at a 15-20% growth over and above the average industry, 2x of the industry growth.
Okay, thank you very much and wish you all the best.
Thank you. Next question comes from the line of Saurabh Jain with HSBC. Please go ahead.
Hello. Thank you so much for the opportunity. If you can give some more insights into your guidance. When you say a single-digit growth guidance, so that kind of implies a broad range from 1% to 9%. Is there a possibility you can give a sense on whether it's going to be a mid-single-digit or high single-digit kind of guidance? That's my first question, please.
Well, very clearly, a bit early, but we've looked at the median growth level this year, given the industry headwind, the uncertainties of climatical situations and policies across the globe. As you said, we would definitely see some positive trends coming in H2, but that's where we stand for now, and we would keep that outlook for the present.
And when you say H2, do you mean by calendar year or it's going to be the financial year?
Financial year plus.
Okay, understood. Possible to also, give a sense on how do you see the exports versus domestic, in terms of your guidance, both business going by single digit, or I presume domestic would be higher?
Yes, obviously, given our hopefully keeping the climatical situation the positive trend, we would see a good growth in the domestic business. As you are very well aware of the global headwinds, so that's where the areas are still under challenges from the export front. But that's what we believe that from H2, the export business would start picking up well with our launch of our new products and the growth in those areas. Yeah.
Okay, thank you. My second question is relating to CapEx. The 925 crores of CapEx, this includes the amount that you paid for PHC acquisition, right?
No, this is only the fixed assets addition. So there is a small minor amount which has been added at the consolidated level arising from the PHC acquisition, but primarily relates to the capex spend what we have done at PI and at PIHS.
Okay, understood. And one final bit on the acquisition side, can you give us a direction in terms of how much of the capex you are directing towards your legacy AgChem portfolio? Does it share a major part of your capex, or it has moderated? Any insights would be very useful.
No, I'm not very clear of the question. What do you mean by legacy AgChem portfolio capex?
So the key products in the portfolio which you export for the last few years, which are some sort of headwinds now, those products, are you committing more capex incrementally, or is it slowing down? Any sense on that side, please?
No, I think the company looks at capex based on what are the requirements of the business plans, order commitments, customer partners in a product, and value efficiency drivers. And typically, the existing products already have assets which need constant upgradation improvements in all those areas. So that's a mixed bag, and that's typically how they look. But when we build assets, we're more strategically investing majority of that for building for our new offerings and our new product solutions.
Okay, sure. Thank you so much and all the best.
Thank you. Next question comes from the line of Madhav with Fidelity. Please go ahead.
Yeah, good afternoon. Thank you so much for your time. I just had one question. I think we have one NCE which you said has reached phase 3 trials. Just wanted to understand that, if we'll be launching our own branded product in the market, does that create like a longer term conflict of interest with our existing model, which has been a more contract manufacturing CSM model, and we partner with innovators?
I'm not certain about how do you look at it as a conflict of interest, because PI in any case is also doing branded sales, it's also doing contract manufacturing, it's also doing innovation. The unique point of our capability at the global level is partnerships across the value chain. Actually, this gives some of the business partners are strengthening our relationships from being an innovator to a market goer as a co-creator to develop this business. So I don't really see that as a challenge.
Okay. The reason I ask is because our branded business is more focused in India, whereas our exports used to be more contract manufacturing driven. So that's why the question. Got it. Understood. Great,
the same way the products will work. So they will work on the same ground. Partner globally, locally partner and sell with ourselves. So that's all the same business, leveraging the same capabilities.
Understood. Great. Thank you.
Thank you. Next question comes from the line of Krishan Parwani with JM Financial. Please go ahead.
Yeah, hi, sir. Thank you for the opportunity. A couple from my side. With strong 65% growth in the pharma business, do you expect pharma business to turn a bit up positive in F26? Or if not in F26, then when?
Sorry? The question is not clear.
Yeah, so I was asking, since you expect 75% revenue growth in the pharma business, when do you expect the pharma business to turn EBITDA positive?
Yeah, so this one will take time, so it's not easy to give you a number that will be, definitely it will take time over next few years, because once we are scaling up, we will also be doing furthermore, whatever, people expenses and all will also go up. So EBITDA break-even, yes, that will be on the horizon, but it will definitely take some more.
Yeah, but
not in FY26.
Very clearly, over the next 26, 27, 28, we should see the positive trends of this business very clearly.
Okay, got it. And on the pioxanilipral, the new NCE, just wanted to understand which major crop would this insecticide be used on, and which is the first country you intend to commercialize in?
Well, this is a diamide chemistry, so we will be looking at it as a multi-crop application. And obviously, the pride would be to see if we can get India first in the fold, but while we're working with 2 or 3 countries with partners for application. So it depends on how the regulatory framework works.
Okay, noted. And one final bit on the capex. How much capex will you be incurring in F26? If you could give down breakdown of agro and pharma, please.
Well, there's no breakdown we would have, but capex in the manufacturing will be around that same area. Right now, about 800 to 900 crores in the similar ratio that we had last year.
Understood, sir. Thank you for answering my question, sir. Wish you all the best.
Thank you. Next question comes from the line of Sumant Kumar with Motilal Oswal Financial Services Limited. Please go ahead.
Yeah, hi, sir. So can you comment on EBITDA margin guidance for FY26?
Yes, so we spoke about it. We would be looking at around 25%, in the range of around 25%.
As our indication.
So now compared to FY25, do we have any expansion from here?
No, expansion as of now, we see when we are looking at the next 12 months down the line, there are investments what we are doing in the other businesses which are going to be a growth engine. So I think for now it is better to take around,
that's our guided line and we continue with that to be very straight.
Okay. And any capex for FY26-27 and tax rate guidance?
The tax gives 25-26 capex should be in the range of around 800 to 900 crores, and the effective tax rate should be around 23%.
Okay. Thank you so much.
Thank you. Next question comes from the line of Riju with Antique Stock Broking. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. So my question regarding in terms of the guidance that you have provided. So the growth that you were expecting, so it is mainly driven by the volume or kind of a price increase you were expecting?
So if you see the performance of last year, 9% volume growth, 6% on value growth, hoping the prices are looking to be stabilized, we should be looking, volume will definitely grow, and that's the objective, volume, and so that balance should remain dependent on how the market reacts. This is not a straight line walk, but as you know, if sometimes prices go down, volumes pick up, prices go up, volumes go down, but that's usually the range and balance if you look at all companies in the segment play with.
Yeah, okay. Understood that. And in terms of your, the growth in the Q4 and as you reported in the presentation, so what I believe is that there was a strong growth in volumes and which was partially offset by the realization growth. So like how are the end product prices currently, and how do you see going forward those prices?
Sorry, which segment?
In terms of AgChem exports.
Well, the segments, I think, as you would appreciate, that the AgChem, we are continuing to grow our new product pipelines at 30-odd%. And if you look at the products in the individual areas, which areas, which segments those are with the customers. So broadly, that's the strategic move. PI continues to grow the existing product portfolio in the same ratio, while the other products continue at a steady state growth rate. Yeah.
That I understood, but what I wanted to understand is that during the quarter Q4 FY25, our agri exports volume growth was roughly 7%. Correct me if I'm wrong. So vis-a-vis, one can expect that there was a sharp decline in the prices. So how do you see these prices going forward?
Let me take this. So yes, I mean there is obviously some price softening, and that is on the basis of input cost, which is also softening. So over last 1 year, 1.5 year post COVID, input prices have come down. Okay, and given our business model of CSM exports, where these input cost improvements are also passed on or passed through, and therefore the pricing of some of these products, existing products, have also come down, which is also reflecting in the growth numbers that you were explaining.
Understood. Thanks for the clarification. And one last thing, kind of a bookkeeping. So if you could tell the order book size that we have currently as on Q4 FY25.
Yeah, this is also 1.3 billion plus, but we don't have exact number in front.
Understood. Thanks for the clarification.
Thank you. A reminder to all, Next question comes on the line of Keyur Pandya with ICICI Prudential Life Insurance Company Limited. Please go ahead.
Thank you for the opportunity. Question on the capex. So FY25 we have spent around 800 crore on the organic capex, and guidance also remains similar number for FY26. I mean, on the current gross block, that suggests that over 2 years the average expansion in the gross block would be upwards of 15-17%, whereas our revenue growth is relatively lower. So anything has changed in terms of asset turn, or eventually the asset turn has to catch up by higher revenues? So if you can just throw some light on this and the breakup of the capex on domestic, exports and pharma, or any color on capex. Thank you.
As you would understand that we are building a new vertical called pharma. Obviously the capex turns will be lower till we get to a certain scale and size. On the other hand, capital, if you look, these are cyclical in nature. In the past, they've always as capacity leads demand, and therefore we're building capacities based on certain demands and understandings from our customers of products which are in the pipeline. So we do believe that overall, on an average basis of 3 years, we should be able to continue to manage our asset turns and better that.
So just one follow-up. So sustainably, what kind of asset turn at a company level or segment-wise we should think of, and breakup of capex in these 3 key subcategories? Thank you, and all the best.
The asset turn continue to be at the similar range. I think today we have one of the benchmark asset turns in the industry, and we will continue to try and continue to manage the same.
Yeah. So
2.6, 2.4.
anything between 2.2 to 2.5 is what we will consider a sustainable number of capex turn.
And the breakup of capex?
Maybe Sanjay, you can take this.
Yeah,
Major capex of this is for our CSM exports, and some bit of it will also in coming year will be for pharma, of course. But Sanjay, maybe you can share the breakup if you have.
Yeah. So broadly in the 800, 900, when you look at it, around 100 out could be in the PI, the pharma business, and the balance will be in our the manufacturing business, in the AgChem business.
Okay. Thank you.
Thank you. Next question comes from the line of Himanshu Binani with Anand Rathi. Please go ahead.
Sir, Thank you for taking my question. So, sir, again, on the guidance side, basically, so we have been like guiding for a 75% plus sort of like growth in the pharma business. And on a console level, we have been like guiding for a single digit sort of like growth. So just wanted to have a sense in terms of how one should actually look into the CSM exports business growth. So that should, so how one should actually work with the CSM exports business growth for FY26?
So when we look at pharma, I mean, it's only say 5% of our total business. So that will not move the needle for the whole organization. And the whole organization, as we already mentioned, that we should be in the mid-single digit growth plans for this financial year.
Got it, sir. Got it. And sir, any sense on the gross margin guidance?
Yeah, which is, see, we always give because there will always be a function of product mix. Yes, Mr. Sana, you were saying something?
Yeah, so I was saying that which will remain around 50 to 52%, depending on the final product mix that we are able to achieve.
Got it, sir. Thank you.
And for CSM, we have to also keep in mind that in last 3 to 4 years, we have been growing at 20 to 25%. So obviously the base is pretty high. And as we have guided that for next couple of quarters, while the industry, global industry is navigating through this headwind, but we certainly believe that from the second half of FY26, we should be able to again catching up, the growth momentum, and that's how it will function.
Got it, sir. Thank you. That was helpful.
Thank you. Next question comes from the line of Somaiya V with Avendus Spark. Please go ahead.
Hello. Thanks for the opportunity, sir. So first question is on margins. So in the domestic side, the biological seems to be the next growth engine. And then also on the CSM side, your new products is like roughly around the 30%, as you mentioned. If you could just give some color on margins in both these businesses directionally compared to biologicals versus existing branded in domestic and a new product versus the rest of the other portfolio with CSM, that should be helpful.
So we don't do individual level, but I think broadly, as you would know, biologicals have a better margin. And the ratio improves, that gives a better play. And for new products, again, it's a bag of mixed bag. So that's how it works.
Okay. Got it, sir. Sir, also, when we are giving this FY26 guidance, so we have given it for, broadly pharma, and then we have broken it down. So what is the thought process for the 70% of the CSM business, which is the not the new products one? What is the volume versus pricing thought there? I mean, would it be, a volume that will kind of overtake pricing, and then that's how we are looking at it? What broad thoughts there?
Well, that's not the right way. As I said, it's a balance between volume and price, but obviously that's going to remain in line with the industry as we have those are mature products and some are new products, so they will work with the market dynamics. And that's typically, as I said, in this industry, that's the genetics of this industry, that volume or price continue to play a differentiated role, yeah?
Okay. And just to add to this, so obviously again there is a portfolio of products. There are legacy products. There are new products, as we are saying. Significant percentage of new products are getting added, and they are contributing in the growth. So in fact, pricing also works like that. That in terms of old products where the input cost is improving, obviously those improvements are passed through, and the price reduction happens, and all that. But as far as the new products, innovative products that are being launched, where the input costs are kind of sort of stable, there the pricing trend is different. So on a blended basis, it is not so simple to tell you that pricing will be 5%, 10% down, and volume will be 15% up or something. So it's a blended situation here.
Okay. Sir, also, the AgChem CapEx that you are referring to, any multi-purpose plants that are expected to come this year, next year, or is it more of, existing facilities we are putting in CapEx? So how does it work?
So as we have said in the past, we are doing a CapEx. We have 2 multi-purpose plants which are under construction. We expect to commission one this year, maybe the beginning of next year.
Helpful, sir. Thank you.
Thank you. Speakers, can you please come a little more closer to the mic and speak? I'm promoting the next, that is Sivanshu Dubey with Dhruv Investment. Please go ahead.
Hello.
Yes.
Yeah. Congratulations for a great result, sir. But actually, I wanted to understand the working capital cycle. Would we expect it to remain in the same number of days?
Yeah. So
Go ahead, Sanjay.
yeah, so we have seen a slight reduction in our net working capital in this particular financial year, but inventory days have come down. So for the year, you may consider the range what we have. So we are at around 73 odd days. The safe thing could be take around 65 to 70 days. Yeah.
Sure. And can you also tell us about the new products development that is happening in the AgChem export with pyroxasulfone going off patent in, I think, mid of 2026 in USA?
So what is that you're looking to get? Because yes, as we said, the new products over the last few years have been growing at a CAGR of 30%, and that's really where we are on that product portfolio.
Okay. Sure, sir. Thank you so much.
Thank you. Next question comes from the line of S. Ramesh with Nirmal Bang Equities. Please go ahead.
Hello. Thank you for the follow-up. So when you talk about the target for the bio business, would it all be focused on the domestic market, or does it also include some growth from the plant health investment in the subsidiary?
Yeah, so we're looking at biologicals as a play, primarily driven by domestics right now, but for the next 5 years, it will become a global play.
Okay. And in the pharma business, in your slide 17, you mentioned about improving order book visibility. So is it possible to share the line of sight there in terms of discussions or inquiries? What is the thought process there?
So let me put it this way. Yes, we can give it a high level. Obviously, you would understand the confidentialities both from a customer name and products and areas that you're working. So Ramesh, maybe you would like to give some insights that yes, you've then looked at what you're looking at, a broad line of development. Ramesh, over to you.
Yeah, sure. We continue to build the pipeline. We have, over the course of the last year, added early development pipeline, meaning new projects and high single digits on the on early development, and high single digits also on late development. That's the pipeline moving forward. We also onboarded 2 new big pharma customers, and the goal in FY26 is to add another 2 or 3 so that we can have a sound base of big pharma that gives consistent revenue on biotechs that presumably can give you better margins. That's sort of the play that we are progressing with.
Thank you very much. That's helpful.
So Ramesh, are you done with the question?
Yeah, thanks.
Thank you. Ladies and gentlemen, we have reached the end of question and answer session. I would now like to hand the conference over to the management for closing comments.
So once again, thank you to all of you for participating in the PI investor call. We look forward to positive times going forward and continued support. Thank you.
Thank you. On behalf of PI Industries Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.